Welcome to this week's Video Insight. My name's Scott Phillips, Head of Client Relationships, and with me today we've got Russell Muldoon and Roger Montgomery. Welcome, gentlemen. Russell, now that reporting season is over and the dust is settling, can you point to a couple of businesses that delivered very strong results and have bright prospects going forward?
Thanks, Scott. So maybe one of the largest positions in both our funds at the moment is a business called Sirtex Medical. Now, what really surprised us in this result was a large increase in marketing expenses and management flagging. Another $10 million will be spent ahead of the key trial Surflocks, which is due out in mid-2015. Now, what this trial is designed to do is move them from the salvage setting into the first-line setting in terms of treatment for inoperable liver cancers. Now, if this is successful, then dose sales may potentially increase from about 8,500 presently to around 30,000 in the current couple of years. So this is a business with very bright prospects if all this comes true. So management wouldn't be spending that much in terms of marketing and getting the device out there and in front of oncologists if they didn't believe that the results were going to be favourable for the business. On our current modelling, we expect in the years ahead that this business could be worth north of $45 a share if everything comes forward the way it should be. And this result just backs up our thinking. Another business that has very bright prospects, and indeed it's the #1 position in both our funds, is Challenger Financial. It's one of the few listed businesses on the Australian Stock Exchange that has incredible structural tailwinds behind it. Now, those tailwinds largely persist because my mum, your parents, they're entering the retirement phase. They're moving away from accumulation into retirement phase, and they're needing products which give them a stable and reliable income stream over their retirement years. Challenger has really built this market over the last decade, has fostered it, and they're really the dominant player in terms of annuities in Australia, so they stand to take a large amount of this market. We currently estimate that that market could grow by a factor of 30 in the next 20 years. So it is an amazing tailwind to have behind the business. So if this comes true and they can hold their current market share, we think the business is worth circa 30–40% more than where it's trading today. So it's another business with very bright prospects that reported well.
Roger, by our own estimations, the market appears somewhat expensive. Does this mean that we're due for an imminent pullback or possibly a bigger correction?
Just because the market is expensive doesn't mean it's imminently going to fall. It can remain expensive for a long time. In fact, in the research that we've conducted just over the last 10 years, we've seen that the market can remain expensive for 3 years or more. It varied in how expensive it was in the years prior to the GFC, from about 1% expensive to 27% expensive before the correction. Given that we've got very, very low interest rates that are unlikely to go up in the foreseeable future, I would expect that the push by baby boomers particularly to get out of the cash that's burning a hole in their pocket into other assets will mean that we'll continue to see gains in stocks and we'll continue to see gains in property. Now, of course, nothing moves in a 45-degree line or an even steeper straight line, so there might be bumps along the way, but until interest rates go up sustainably and until investors believe that's going to be the case, I think we're going to see rising asset prices, but we still hold a large amount of cash.
Roger, given the Montgomery Fund has a flexible cash weighting, unlike most other funds in the marketplace, what role do you see it then playing given the current situation around valuations?
So our cash, let me say this at the outset, our cash weighting has been a drag on our performance, but despite that very high cash weighting, we've still managed to outperform the indices for both funds since their inception. Cash falls out of our investment process when the market is expensive. The level of cash that we have increases. When the market is cheap, the level of cash we have declines. This works in our investors' favour because when the market becomes more expensive, it's prone to negative shocks, and we've already got more cash to take advantage of cheaper prices. An example of that would be Ainsworth Gaming. We believe that business could be 2 or 3 times bigger than it is today in 5 years' time. But in the interim, it's actually going to go through a period where it's cycling really difficult comparative numbers, or what analysts call difficult comps. And so we think there could be a period where its share price suffers. Having more cash allows us to take advantage of that opportunity. Unlike other fund managers, we're not putting a wetted finger in the air and deciding on how much cash to have based on gut feel. It's falling out of our process. So I want to impress upon you the importance of the cash, but also that it flows out of the valuation of the portfolio. When the portfolio is expensive, we've got more cash. When the portfolio is cheap, we'll have a lot less cash.
Well, there you have it, the latest thinking from Montgomery Investment Management. Thanks for listening. And remember, please follow us on Facebook and Twitter. We look forward to seeing you next week.